Hey, good evening. Welcome to the podcast, everybody. Thank you for joining me here on a Tuesday, October 15th. It is episode number 200 of this new format of the podcast where we do a little more video, and I guess it's evolved a little bit. And if you want it to continue to evolve, give me some suggestions. I want to know kind of what you're wanting. If you're wanting more questions answered, if whatever it might be, the look of it, let me know. Well, it is the episode 200, and it comes on a day where the Dow Jones finished down a little shy of 1%, about 0.87%. The S&P was down 12, about 0.75%. NASDAQ was actually the best of the three, down only 0.5%. Bonds were kind of flat on the day. Gold had a good day, and if you are long volatility, you had a good day as well. And we'll kind of start there because stock market has been doing pretty well since we talked about that nice setup that it had a few days ago where it made that pretty nasty day. It kind of reversed in the middle of the day, and then we had that 90% up day after it looked like there was going to be a deal. And then, of course, we come through the weekend. There's no deal, and now we're getting a lot of jawboning back and forth, which, by the way, that's what I think it is right now. But here's the volatility spikes. Now, what makes this little spike a little different is all of these other ones, as soon as we went up, we started to come back down, and then it continued down. With this one, we've gone up, we started to come down, but it didn't go all the way down to the bottom. It turned back up now. And so it makes it kind of difficult because this is really what we had looked for, was a temporary spike in fear, which we got. Sorry to change the colors of the arrows. There you go. So we got a temporary spike in fear. And we said the best time to buy stocks is when that fear just starts to subside. And when it started to do that, that was a good time to go in there and buy if you were wanting to do so. We talked about the stocks that were beaten up the most, kind of those go-go stocks that some you would question the fundamentals, but they were cult stocks. They were stocks that were very momentum-based, and they have had a nice bounce back. So volatility now has gone back up into the fear zone, kind of the don't buy. If you want to be early, you can buy, but we need to see the fear subside. Today, the volatility index was up 16% to 18.66, which is a pretty big day. So let's take a look at the S&P 500. If this channel is to continue, which I don't see any reason why it wouldn't, we're now in the middle of it, right? So the time to sell is up here, the time to buy is down here, and we're now right in the middle. So if you're into the shorter term trading, then you really don't do anything right now because we're in this zigzag, and these little ranges are getting a little tighter. And of course, we could go back down, we could fall a little further. But so far, what's been happening is we will work our way up to the top at some point and then head back down. And yes, this won't last forever. But I think what's going on in Washington right now, to me, and again, I'm not, I follow a lot less politics nowadays than I used to. I've got kids, I've got my own company, and I keep up with it, but I'm just not I'm not following all the day-to-day comments. I see the things come across the wire on Bloomberg, I hear the comments, but when I stand back and look at this, to me, it seems like things get their worst right before a deal is done. And I don't know about you, but it seems like we've seen this before where we're almost going to have some type of deal, and they're holding the nation hostage, right? And right when there's a deadline coming up, and there's really no benefit of anybody to not go all the way to the deadline, right? Because it shows they have a weak hand. So what they do is they jawbone, they get on TV and say, well, we're going to do this, we're going to do that, we're not going to do this, kind of pointing fingers. And the stock market, in the meantime, is getting caught in the crosshairs. And what we have, basically, is this 5-minute picture of the S&P that's zigzagging on every single word, where we have these big downdrafts, opening up. Then all of a sudden we rally and we go positive on the day. Then it drifts a little lower. And then it really sells off. And then it's coming back. And then it sells off into the close. All of this is based on headlines. This is a headline. This is a headline. This is a headline. All of these things are based on the headlines coming across. And that doesn't have anything to do with long-term investing or even medium-term trading. But here's what I think's going on. I think this jawboning back and forth is one last ditch effort to get their point across before everybody caves in. And they're both going to have to cave in a little bit. But why not do it at the very last minute when you say, I gave it everything I had, but at the end of the day, we couldn't get what we wanted passed because we were running into this situation where we made default. And we couldn't have that happen, so I had to give in. But if you do it today, you're doing it too early, right? You're doing it a couple days too early. I'm just playing devil's advocate thinking that's probably what they're thinking. That's what it feels like to me. It's just like when they came out today and the Senate said we're going to delay any of our talks. We're going to put them on the back burner right now until we see what the House comes up with. And immediately the stock market sold off. I think it was right in here, if I'm not mistaken. Yeah, it was right in here. They said we're going to delay the talks until we see what comes out of the House. So the immediate rumors pop up. There's no deal, too far apart, et cetera, et cetera. But the way I looked at it was, why would you go to all the trouble to keep talking to come up with a deal if the House is just trying to come up with their own deal? Why not take their deal and modify it, poke holes in it, instead of coming up with two completely different plans? So, again, this is just a layperson talking, looking from the outside, but to me it kind of made sense that the Senate would pause, and yet the market took it at, here we go, and it sold off. Now, after the bell, we get we're on credit watch and a possible downgrade coming. Remember, we lost our AAA rated status back in 2011 from S&P, Standard & Poor's. Another rating agency didn't. Fitch. They're still AAA. Now they're threatening to drop the AAA rating. So, again, we're getting down to the wire here, and, of course, nerves are going to pick up a little bit, and you're going to see the volatility pick up, and you're going to see the stock market sell off. But what we have to focus on is the longer-term trends. And I mean longer-term trends in the sense of the overall supply and demand. Again, what's going on in the big picture? And in the big picture, what you want to see is this. You want to see the trends. You want to see, which basically is the moving averages, right? That's what we want to focus on. And really, if you want to, you can focus on the blue line or the purple line or the red line. It just depends. If you're trading, then maybe you want to focus on the green line. But let's just take the blue line, for example. It's been going up. It's been pretty steady. Kind of flattened out here, right? So you could say the momentum has slowed a little bit, but all it takes is a few good days, and we already had a few. We had the 90% up day, until all of a sudden this thing starts turning back up again. But what I've done is taken out the daily prices, so you don't see the prices, and that makes you a little clearer thinker. And right now what I'm seeing is the sell-off that we've had today was not an intense, horrible sell-off. It was not a dramatically fear-based sell-off. Yes, the VIX popped up, but that's mostly people going in and buying insurance. Now, I talked to a person today who's a hedge fund manager and says, hey, bought some insurance because when the VIX is below 15, we kind of go in there and think it's cheap. We buy it, and we kind of buy some puts on the S&P 500 because stocks are extended. And so that's trading. That is hedging. That is, taking some off the table, just maneuvering a little bit. But in the big picture, that isn't somebody who is saying I'm going to get ultra bearish because a lot of this stuff is just noise. So look at the prevailing trends, and right now they're still up. The overall market is still healthy in the sense of supply and demand, and that's the bottom line. But we did bounce right off of where we were supposed to, which was this 100-day moving average. And as I've told you in the past, it's not that I always look at the 100. Just in this case, it's worked the last few months. And, we bounced off there once again. Some of the bears are pointing out that each time we've made highs recently, some of these highs, we haven't had as much breadth in the market. In other words, we haven't had as many participants. And that may be true, but it's not dramatic. And so again, I'm not making a lot of moves. I did buy some gold miners today because of almost an insurance policy, and they performed very well today. But that was more of an aggressive move for my aggressive strategy, which is something that with a tight stop, but something that can move opposite the market while there's a little turmoil. Because when there's fear, and if fear picks up over the next few days, that should work. Is it something I'm betting on for the next few months? No, but they are so beaten up that we went in there and bought that. And that was something my analyst brought to me and said, hey, take a look at this, and we looked at it from several different angles. In gold miners, and this is just the junior gold miners, but very, very stretched to the downside. And the way a lot of this works, and this is more trading than investing, but when you get something that snaps real hard like it did here, the bounce backs can be violent. Violent meaning good. We've had a big drop, right? We've gone from a price of, let's say, $52 on the junior miners all the way down to $35 in just a couple of months, less than 2 months. Big drop. Even if you get a bounce up to here at $45, that's a huge percentage move, and then you can put your stop underneath it, and if it rolls back over, you've made your money and moved on. If, however, on the other hand, it doesn't do what we want, then what you have is, you've got your kind of your floor here where you're saying, I'm going to give it to the old low, maybe even a little bit lower somewhere in here, and that's going to be my stop. This is just trading. This is just looking out over the whole landscape and saying, you know what, if the stock market continues to fall, if fear picks up, what would I be buying? What could be an insurance policy? And sure, you could buy an inverse ETF. That's kind of an easy one. But what about something that's just really stretched to the downside here? And we basically thought it was the junior miners. So this is something he brought to me. We took a look at it. We analyzed it from several different angles. And technically, we think it's setting up for a possible bounce. It got stronger as the day went on. Pulled back a little bit at the end of the day, but finished up almost 2.5% on the day. So again, that's something that could pop very easily. Even if it moves up to one of these moving averages, that's $42, folks. That is a big percentage move. That's almost 20%. And then you could see it roll over. So there's things you could be doing like that, but overall, when you look at things like the NASDAQ right now, does that look scary to you? Is that a picture that you would say, I definitely have to be selling? No. I mean, are there some cracks? Yeah, there's a little bit of cracks here, but again, if they resolve this, if they come up with a deal that's better than people thought, the economic numbers come up better, whatever the case, this is going to continue to go higher. And the Fed is still in play, and we know they're still in play because they've told us. And now we have Janet Yellen, who's probably going to be sworn in at some point, and is dovish and going to continue what Ben Bernanke started. So all of this leads to, I think, higher stock prices in the future. Now, that's not a commentary on what's going on in Washington because it's a mess, and putting a Band-Aid for 6 months, 4 months is very frustrating. As I said last week, it's like putting duct tape on a old clunker. At some point, you're going to need a new car. But let's look at it from the stock perspective, because that's what my job is to help you make money, help myself make money, help my clients make money. And the thing is, when you look at it from this perspective, interest rates still low, economy's okay, people see Europe improving, there's still stimulus globally, and by the way, the Fed's still engaged, stocks are still the only game in town. Okay? And so, again, take a look at the NASDAQ. Does this look like a scary picture to you? Not really. Let's take a look at Treasuries, TLT, the ETF for that. And you can see here they look like they were starting to bottom. But, again, if the economy, if they come to a deal, and as I said before, this almost kind of looks like an Apple picture. Remember, an Apple was going straight down, then it started just to go zigzag. Maybe that'll happen. But look, we want interest rates to slowly start to go up, and this is TLT. But let's take a look at rates themselves. We want rates to go up if the economy is getting better. What would cause people to get nervous is if the economy improves too much, which I don't think it will. But if it improves too much and rates go up too fast, that would spook equity markets. Or if the stock market itself goes up too fast on its own accord, And so if we look at the S&P 500, if we were to see the market just take off and move up to 1,800 very, very quickly, then you could see some serious profit taking at that point. But for now, look, don't get whipsawed in this market. This is a very easy market to go in there, buy something, and only to see it go down, and then sell it, and only to see a piece of news come out and it goes back up. The best thing that I have done the last several weeks has been nothing. Has been very light. I haven't weighted too heavily in one area or another. I haven't done too many trades. I've been being very patient, letting the positions work. On good days they go up. On bad days they may go down. But overall, we're still collecting a lot of income, still have some cash, and still staying in the sectors that are working the best. That's one other key, is to stay in the areas that you think are the strongest. Not to say you shouldn't be buying contrarian type investments, but overall you can really trade yourself right out of this market, and it can happen intraday because of the headlines. The markets move so fast, and so just be careful and stick to your strategies, but don't let some of the short-term noise fool you. If something goes wrong here and we do default, it's going to be very messy, no question about it. But I really don't think they're going to let that happen, and they're playing a game of chicken here, and it's scary, right? No question about it. And let's not be flip about it, but we have to pay attention to what investors are doing. And right now, when you look at some of the fear indicators, when you look at the stock market, I'm not seeing the same type of action we saw in 2011. And so the stock market is not betting on this continuing. Yes, there's a little doubt in everybody's voice, including mine, that something bad would really happen. But at the end of the day, these guys don't want to have it on their watch to be the first to do this or the first to do that. So let's just see how it plays out the next few days. But overall, I personally am not making any major moves one way or the other. All right, guys, that's the 200th episode. So 200 down, and I don't know how many left to go. 300, 500, 1,000? I don't know. We'll see where this takes us. But again, I'd like to know if you want to see some changes to it, because I want to do stuff that you guys want. So feel free to email me, Karl@eggerscapital.com. Let me know what you're thinking about it. In the meantime, we're on Google+, Facebook, Twitter. It's at Karl Eggers. We are at eggerscapital.com and iTunes, etc. So thanks for joining me, and we will talk to you soon. Have a great evening.